Well, hey everyone, welcome to this vodcast, Activity-Based Costing, or ABC, a smarter, more strategic way to trace cost to stuff that actually causes them. So buckle up, because this week you're about to become fluent in your ABCs. I'm Professor Jeff Byrne, and I'm excited to be here with you. Here's what we're covering today. First, we'll define what makes ABC different and, frankly, better than traditional costing. Next, we'll define activities, create cost pools, assign overhead to these cost pools, and then allocate those costs to products and to customers. We'll calculate activity rates and then walk through real examples using overhead numbers, machine hours, order quantities, and more. By the end, you'll be able to look at a product or customer and say, now that's where our money is going. All of this and more right here in today's vodcast. So let's set the stage. Traditional absorption costing, great for GAAP, not so great for decision making. ABC flips the script. It asks, what's actually causing these costs? Instead of spreading all overhead like peanut butter over every unit, ABC targets the real culprits, the activity. ABC is basically the detective of cost systems. It looks at really all cost and tries to decide if there's a cause and an effect relationship between the cost and the cost object. ABC, it may assign non-manufacturing costs to products. Crazy, right? Well, but only if the product causes those costs. Traditional systems, they never do this. ABC, it may exclude some of the manufacturing cost, like organizational sustaining cost and idle capacity from the products. Traditional systems, they allocate all manufacturing cost to products. ABC uses many cost pools, each with unique activity measures. Traditional systems usually rely on fewer pools and volume-driven allocation bases. Now, let's understand a few terms used in ABC costing. An activity is an event that causes a cost to be incurred for producing a product or for providing a service. Let's consider the example of Cab Corporation, a company that operates a fleet of vehicles for taxi service. Providing taxi service, well, that's an activity for the company. An activity cost pool is a bucket in which costs are accumulated that relate to that single activity measure. An analysis of Cab Corporation would show that they have three activity pools: travel, pickup and drop off, and customer service. An activity measure is an allocation base. It is a measure of the amount of activity that drives the cost in activity cost pools. In this example, the activity measures are miles for the travel cost pool, number of pickups and drop-offs for the pickup and drop-off cost pool, and number of customers serviced for the customer service cost pool. Activity-based costing defines 5 levels of activities. Now, one is a volume-related activity, like what's used in the traditional system, but then there are 4 non-volume related. First, unit level, like activities for every single widget you make, okay? Well, that's the same as in volume-related activity. So generally, the distortion that's revealed by ABC will not arise in unit-level activities. ABC's difference is primarily coming from non-volume level or non-unit level activities, and there are 4 of these. First, batch level, activities tied to groups, like setting up machines once per batch. Product level, supporting a whole product line, like designing the newest and greatest thing. Customer level, things done just for your customers, like a sales call or a repair trip. And then finally, organizational sustaining, stuff that keeps the lights on regardless of what you sell, like HR, legal, or Monday morning donuts. Let's zoom in on the company Buggy Corporation, a leading manufacturer of electric golf carts. In addition to golf courses, they've expanded into resorts, retirement communities, and high-end neighborhoods. But here's the issue. Profit margins are shrinking despite solid revenues. Leadership starting to ask, is our traditional costing system hiding the real story? Are we undercharging for customization? Are our standard models covering everyone else's overhead? So they form a cross-functional team, pulling in folks from accounting, production, engineering, marketing, customer service to figure out where the money's really going. That team decides to implement ABC to get a better visibility into the true cost of products and customers. Activity-based costing estimates the cost of the resources consumed by cost objects. A cost object, well, that can be a product or a service that generates activities. For example, Buggy Corporation, a golf cart is the cost object triggered by an order from a customer. This order made by a customer requires an activity. The activity here includes the preparation of a production order. Preparing a production order consumes resources, say, for example, paper, and this resource has a cost. Activities form the link between cost and cost objects. Okay, there are 5 steps for an activity-based costing system. The first is defining the activities, activity cost pools, and activity measures, and this is a big one. The ABC implementation team at Buggy, they will probably begin by interviewing people in the overhead departments to better understand their major activities. These activities summarize the work performed in overhead departments. The number of times materials are ordered, the number of setups in a factory, and the number of shipments made to customers are all examples of activities. At Buggy Corporation, the ABC team created 6 activity cost pools shown here. First, machine processing, all cost of resources that are used as a consequence of the number of units being produced. This cost pool includes the cost of miscellaneous factory supplies, power to run machines, and some equipment depreciation. Now, this is a unit level activity because each unit requires some of these resources. The activity measure for this pool, well, it's machine hours. Next up, machine setup. Well, all the cost of resources that are consumed in setting up machines for specific orders. The activity measure for this cost pool is the number of setups. This is a batch level activity because each setup generates work that occurs regardless of the number of units. The third, customer orders and shipments, okay? These are the cost of resources that are consumed for customer orders received, including the cost of processing paperwork and completed orders shipped. The activity measure for this cost pool is the number of shipments. This is a batch level activity because each shipment generates work that occurs regardless of the number of units. Okay, getting the point here? Next up, customer service. These are the costs associated with maintaining relationships with the customers, including the cost of those sales calls, entertaining the customer, etc. Product design. These are the cost of resources consumed for designing products. The activity measure for this cost pool is the number of products designed. This is a product level activity because the amount of design work on a new product does not depend on the number of units ordered or the batches that were run. And then last up, other cost pools. Well, this is all overhead costs that are not associated with the above. These mainly consist of what we call organizational sustaining cost and the cost of unused idle capacity. These costs are not assigned to products because they represent resources that are not consumed by the product. Okay, so here is the income statement and the annual overhead cost of Buggy Corp. Now notice that overhead is classified according to the following departments. We have production, we have administration, and marketing. Notice that the total in production equals the total manufacturing overhead. Similarly, administration expenses of $700,000 equals a total in the income statement of general and administrative expenses. And the same for marketing. $400,000 of cost equals the marketing cost as shown on the income statement. Now, it's important to note that the existing cost system can accurately trace direct materials, direct labor, and even shipping expenses to those products. There is no need to incorporate these direct costs in the activity-based costing allocation system. All items that are not traced directly can be allocated through activity-based costing, including manufacturing overhead, administration, and marketing cost. Coming up, we're going to look at each individual overhead cost and try to allocate the portions of that cost to those different activity pools. First up, indirect factory cost of $750. So ABC divides overhead cost among activity cost pools using an allocation process. This is called first stage allocation. First stage allocations are based on interviews with employees who have first-hand knowledge of the activity. At Buggy, the team needs to allocate this $750,000 of indirect factory wages to the 6 different activity cost pools. For this, indirect factory workers such as supervisors, engineers, quality inspectors are asked to estimate what percent of their time is spent dealing with things like machine processing, machine setup, customer orders, customer service, product design, or just other stuff. The results of these interviews would be compiled and it would show that, 30% of the indirect factory workers' time is used for machine processing, 10% for machine setup, 20% for filling customer orders, 10% for customer service, and 25% for product design. The remaining 5% represents idle time and is entered under the column Other. Next, the production manager is interviewed regarding the allocation of factory equipment depreciation. Similarly, all departmental overhead is distributed across these different activity pools. Same for utilities and for factory lease. Note that 100% of the factory building lease has been assigned to the other cost pool. Well, why do you think that's so? Well, this is because the company has a single production facility, which is treated as an organizational sustaining cost because there's no way to avoid even a portion of this cost if a particular product or a customer were to be dropped. As with the production department, the team is going to try to break down the cost for administrative expenses, including the wages, depreciation, administration, lease. Notice that again gets dumped into the other category. Also with marketing salaries, selling expenses, what percent of activity do folks spend on each of these different expense and times? Percentages must sum up to 100%. And remember, this is the first part of that first stage allocation. All right, this is the foundation of our ABC system. These are the real overhead costs incurred across Buggy Corporation's departments during the year. Nothing fancy yet, just the raw numbers. So we have all of these from the earlier sheet that we showed. Those 3 bulk categories of annual overhead costs broken down by individual components, $750 for direct factory, $500 equipment, $180 utilities, $70 factory lease, and so on, okay? So now what we're going to do is we're simply going to apply the percentages to allocate dollar amounts into these 6 activity pools. This $750,000 for indirect factory wages, machine processing gets 30% of that, machine setup 10%, and so on and so forth. And this is done for the same expense. This is done for each and every expense, that's in our general journal. All costs allocate across the activity pools for the times folks spend in those activity pools, or possibly what the team observed as well. This table is just some simple math to create total cost for each type of activity. Let's look at a few. So out of production, the indirect factory wages of $750 times 30%, 10%, 20%, 10, 25, 5 yields these numbers right here. 225, 75, 150, 75, 187.5, and 37.5 for each of the 6 activity pools. With that, our allocation of indirect factory wages is now complete. Let's do another. Next, let's allocate the $500,000 of equipment depreciation. This is from the production manager, likely. Again, we go to the source, the production team, and ask how that equipment is being used across activities. We have $500,000 of cost. They say 50% of it's used in machine processing, 25% for customer orders, 25% other. Allocate that accordingly, 500,000 times those percents for each of the relevant pools. After we do the same type of calculation for each overhead cost, we have fully allocated the $2.6 million of overhead from production, administration, and marketing. At the bottom, we have the totals for each activity cost pool. Machine processing, $493 of total cost to be allocated. Machine setup, $75,000 of total cost to be allocated. Customers, $569. Service, $467. Product design, $279,500. Other, $716,500 for a total of $2.6 million. This table shows the results of all that careful slicing and assigning. And now, finally, we're ready to compute activity rates, much like the poor rates. This allows us to assign overhead cost to individual products and customers based on how much each activity they actually consume. So now we have the activity pools. What do we need now? Oh, we need the cost drivers. We'll call those activity drivers or activity volumes. So the team gathers some records for the total amounts of each activity that has occurred during the period. They find that during the year, the company logged 40,000 machine hours. There were 5,000 setups. They processed 2,000 customer orders. They served 100 distinct customers and completed 20 new product designs. Well, with this data in hand, we're ready to move on to one of the most important steps. Here's where the magic happens. We take the total cost in each pool and divide it by the total activity to get the activity rate. Oh, does that sound familiar? Well, hopefully so. Here are the rates. For machine processing, a rate of $12.33 per machine hour. Every machine setup, $15 per setup. Customer orders, $285. Customer service, $4,670. And product designs, $13,975. And there you have it, how we come up with the little mini poor rates, if you will. We call them activity rates that we can use to apply to products and customers to examine things like profitability. We'll do that with another example next. Okay, so let's understand the assignment of cost to cost objects like products or customers using a different example, Music Systems, a manufacturer of home theater systems. They have two products, the Z-Bass and the Z-Vox. Z-Bass is a product with 800 orders that have been received during the year. Because this is the standard product, there are no new design requirements for this. A total of 20,000 machine hours was required to produce the 800 orders received, okay? Z-Vox is a product with 200 orders have been received during the year. 20 new designs have been prepared because Z-Vox is a custom-made product. A total of 5,000 machine hours were required to produce 200 units. Okay, so the total overhead cost is $1,050,000. Based on the information we have about Z-Bass and Z-Vox, let's assign the total overhead cost to each of these products. The first activity pool is customer orders. The activity rate for this cost pool is $200 per order. Okay. Refresher, we got that in the earlier slide. The cost total was $200 for the year divided by the 1,000 orders, so 200 orders. We know that for Z-Bass, there are 800 orders. Therefore, the activity cost is $160. Okay. Next, product design. Activity rate $7,500 per design. However, no design orders are used for this product. Okay, remember why. Therefore, no product design overhead cost will be assigned to Z-Bass. Finally, the order size cost pool rate is $16 per machine hour, 20,000 machine hours. Sorry, had to look for it. Therefore, the activity-based cost for the order is $320,000. Altogether, $480,000. Okay? Let's do it for their other product, Z-Vox. Total cost of $270,000, which is the sum of the assigned cost of Z-Vox, $40,000 for customer orders, $150,000 for product design, $80,000 for order size. Now we know exactly how much that line costs as well, $270,000. So out of the $1 million overhead, we assign $480 to ZBase, $270 to ZVox. That totals $750. But that doesn't equal the $1,050,000, does it? Well, no. How come? Well, because the $300,000 were those other costs, other activity, organizational sustaining activity. And this activity is not caused by products. When we add that $300,000 to the $750,000, well, then we balance out to the total $1,050,000 of overhead for the company. We can now discuss another example of second stage allocation where activity costs are assigned to customers. Continuing with Music Systems, we assign the cost to one of their customers right here, Harper Home Cinema. Harper placed 200 orders, and one of the orders required a design resource, okay? A total of 200 machine hours was required to fill the 2 orders. We now calculate the activity-based cost of the customer's total activity. So customer orders, activity rate, $200 per order times 2 orders, or $400. Product design, $7,500 per design, 1 design, $7,500. Order size, 16 per machine hour, times 200 machine hours, 3,200. The total overhead assigned to our customer, 11,100 at Harper Home Cinema. So what's significant about product profitability and customer profitability? Well, let's take a look at them one at a time. Product profitability reports are to the common management reports used by ABC, product reports and customer reports. Let's review the ZBase and the ZVox. We compute the profit for each product by using the sales figures, the direct cost, the indirect cost, and then using the information, we now prepare the total product profitability report. Where does this total product profitability report come from? Well, the report reveals that we have direct material and labor cost, and then we have customer order cost that we got from the individual ABC calculation, order size that we got from the individual calculation, and now we can total up all the cost. This cost minus our sales means that this product yields $320,000. Doing the same for the other product. I think I got my names mixed up here. Sorry about that. Total sales of $400,000, direct material of $80 and $72, customer orders of $40, product design of $150, order size of $80. Altogether, though, the total cost is $422 against sales of $400,000. Oh, we're losing money on this product. Losing money on a product? Well, this gives management some excellent data to start evaluating some strategic changes within our product lines. Likewise, we look at calculations for profit for one of Music Systems' customers, like Harper Home Cinemas. For this, we use the total sales that were made to that customer of $18,000. The direct materials were $3,600. The direct labor was $2,700. We can then take from the ABC reports the cost of overhead, $400 for customer orders, $750 for product design, $3,200 for order size, $11,100. The total cost for this customer was $17,400 against total sales of $18,000. This customer, we've only made $600 on this customer for the year. A similar report can be made for each of the company's customers to see, do we want to thin out any of our least profitable customers? Something to consider. Well, this helps the company to cultivate relationships with its most profitable customers and take steps to reduce the negative impact of unprofitable ones. Well, let's recap what we've covered in this vodcast. We saw how ABC helps managers make better decisions by tracing overhead to real activities. We learned how to define activities, build activity cost pools, and choose appropriate activity measures. We walked through the 5 levels of activity and saw how ABC treats them differently from traditional systems. We followed Buggy Corporation and Music System Corporation through the 5 steps, from defining activities to assigning overhead to products and customers. And finally, we used ABC to calculate product and customer profitability, giving us powerful insights into where companies earn and where losses are occurred. ABC helps you see the cost of complexity, design better pricing strategies, and make smarter choices about the product lines, service offerings, and customer relationships. So great work this week. Get ready to use all this in class, in cases, and maybe even your job before this semester's over. Let's go.